Welcome to another episode of Real Estate Investing Explained. Here's today's question. Who is passive real estate investing good for, and who might it not be good for?
Yeah, excellent. And this takes, it all starts with self-education and self-discovery, right? Who are you and what's right for you and what are your goals and, what's going to help you get to those goals. Some people, quite honestly, are very hands-on, very handy. They like to do their own work. It's kind of a creative avenue. Maybe fix and flips are definitely the right fit for that individual. But you also have to kind of look at risk and reward. And there's other factors besides, I like working on houses. I would say a lot of the investors that do what I do don't exactly have my story per se. It's a lot of working professionals, engineers, VPs, CEOs, business owners, doctors, dentists, lawyer, attorney. It's people focused on a professional career that they're usually good at. They usually don't want to quit their job. They're just focused on something else. And so they're making more income than what they're using. So that excess needs to be parked somewhere into an investment. And a lot of folks don't want all of their capital in, say, the stock market, right? With the volatility and you follow market cycles and things like that. I mean, it may not be great to have a huge lump sum just there. So this could be just another avenue to park some capital, 50K, 100K, something like that, just to kind of diversify your portfolio. The other group of folks probably have more of a story like mine in that they're looking to achieve enough passive income to exceed their lifestyle expenses. And so that could also be a great avenue for it. I know a lot of people do different index funds and bonds and other things, but quite frankly, there's better returns to be had in most cases in real estate. So specifically in passive real estate.
Do you have to be an accredited investor to invest in all of these passive deals that you're talking about?
That's a great question. And for those that aren't familiar, an accredited investor is basically a high net worth, high income individual. You can qualify of one of two ways: $1 million net worth, excluding any equity in your primary residence. If you're an individual, you can qualify on income, $200,000 per year income for the last couple of years. Expectations to do the same in this year. And if you're married, it's $300,000 in income for the last 2 years. Expectations to hit that in the current year. A lot of the offerings in the syndication space are for accredited investors. It comes down to the sponsor and the deal specifically and which regulation they're operating under. There's a thing, 506C, as in Charlie, which is accredited investors only, period. No exceptions. Then there's 506Bs, which I would say the majority of folks are doing 506B, as in Bravo. They can take what's called a sophisticated investor who is non-accredited, but does have the ability to understand the risks involved in what it is they're exactly investing in, whether they have to use a team of advisors to learn this stuff or a family office or something like that. But it just depends. The short answer is no, you don't have to be accredited. Longer answer is a lot of deals are accredited only. So it takes some networking, I guess, to figure it all out.
That's all for this episode of Real Estate Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.